Hi, this is Patty Jameson with MCOL, and I'd like to welcome our listeners to today's podcast session on value-based care organizations. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Hi, Doug.
Thank you, Patty. In this podcast, we'll review the performance of the value-based care segment of the healthcare industry for the fourth quarter of 2021 and year-to-date 2022. Before we begin this presentation, I want to touch on two things. First, we have a new addition to the universe, CareMax. CareMax operates primarily in Florida with 45 multi-specialty medical centers in that state. They've recently opened 2 centers in Memphis and 1 in New York City. The total capitated membership as of the end of 2021 was 50,100, including both Medicare and Medicaid beneficiaries. This addition brings the total number of firms in our VPC universe to 6. We believe the value-based care space is still in its infancy, and we expect additional new publicly traded firms as the space matures. Second, there's been a change to the popular risk-sharing program of the Centers for Medicare and Medicaid Services. It was an important source of growth of Agilon Health, Oak Street, and Kano Health, but changed on February 24th of this year. It will be fully implemented beginning next year, and it's unclear to the managements of these companies what the effect of the change will be. On one hand, the changes in the risk scores could negatively affect revenues, but it is also the case that there will be a reduction in quality reimbursement withholds from 5% to 2%. I want to speak to stock prices and valuation year to date. As of April 12th, the stock prices of the value-based care companies were lower by an average of 19.9% year to date. Similarly, the market capitalization for the VBC sector decreased by 15%. This compares to the 7.7% decline in the broader market measured by the S&P 500. Stock prices for 5 of the 6 firms lost ground so far, led by Kano Health falling 44%, followed by One Medical with a decline of 40%, Oak Street with a 21% decline, Agilon Health declined by 14%, CareMax by 9%. However, previous stock increased by 8.7%. Valuation metrics were mostly lower since the beginning of the year, with price to sales decreasing by 24% to 3 times. Price per total member fell 24% to $17,000 per member. Price per risk member declined by 4% to $37,000 per member. On the other hand, price to net worth increased by 112% to 21 times. By the way, the total members or member equivalents is defined as all capitated members plus attributed members of ACO type arrangements plus patients. Risk members are a subset of that total that are capitated to the VPC. So on to our review of operating trends. For comparability with the other firms, Sherlock Company has consolidated the revenues and expenses of Agilon Health's 5 direct contracting entities into its financial statements. These direct contracting entities are established under the auspices of local physicians and are independent of Agilon, which is why they don't actually consolidate them in their audits. For the fourth quarter of 2021, combined membership increased by an average of 63%, while increasing by 38% in total to 2.2 million members or patients. By average growth, I mean the average of every value-based company's growth rate, total reflects the change in combined membership of these publicly traded firms as a whole. Fully capitated or near fully capitated risk membership increased by an average of 101% and in total by 89% to 475,000 members. Kano Health capitated membership grew by 225,000 to 101,000 members. Oak Street capitated membership gained 78% to 115,000, and CareMax was higher by 60% to 40,000. Agilon Health had an increase of 55,000 capitated members to 186,000 members. One Medical, which recently began to provide capitation arrangements, had 32,000 members. Fee-for-service volume for the universe totaled 853,000 patients, 39% higher than for the fourth quarter of 2020. One Medical had an increase of 154,000 to 703,000 fee-for-service patients. Note that One Medical represents the lion's share of these fee-for-service patients in this universe, in contrast with the more capitation-focused VBCs. The total number of centers was higher by 73% in total and 76% on average to a total of 486 centers. CareMax had the largest percent increase of 88% to 45 centers. One Medical had the largest increase in total number of centers from 107 to 182. For the universe, the total number of patients per center was 2,200 on average, compared with 2,300 in the same period in 2020. Revenues for all firms increased by an average of 124% and in total by 78% to $2.1 billion. Agilon Health revenue increased by 84% to nearly $600 million. Kano Health revenue nearly doubled with an increase of $241 million to $492 million. Oak Street Health revenue improved by 59% to $394 million. CareMax revenue gained 387% to $118 million. One Medical revenue increased by 89% to $230 million. Privia Health had higher revenue by $62 million to $275 million for the fourth quarter of 2021. Capitation rates grew by 2% to a little over 100, or a little over 1,000 per member per month, from almost exactly 1,000 per member per month in the previous quarter. Agilon Health had an increase of 1.4% to $827 per member per month. Oak Street had a decline of 8.3%. Kano had increased by 43.2%. Thus, revenue growth overall for these companies was volume-driven, not price-driven. Operating earnings for the VBCs in the fourth quarter were a loss of $357 million, a reduction of $212 million from the fourth quarter of 2020. Oak Street Health had the greatest loss of $142 million from a prior loss of $91 million. These firms are expanding rapidly and have many new patients. According to the companies, over the short term, health benefits provided to the patients are expected to increase due to their participation with these companies. The longer tenure of these patients with these companies are similarly expected to lead to members' lower costs. Some of these firms are expanding by acquiring other medical centers or partnering with additional medical groups. The onboarding process is costly to the firms given the new members. The average operating margins for all firms decreased by 9 percentage points to 18%. All firms had negative operating margins. The big cost for these firms is the delivery of healthcare. We use the term medical expense ratio for the value-based care firms that I would like to define. It resembles a health benefit ratio for health plans. The numerator is the total medical expenses, which includes the cost of care, third-party medical costs, direct patient expense, other medical expense, physician and practice expense, and the cost of platform. The denominator is total revenues. Essentially, this metric removes administrative expenses and focuses with as much granularity as possible on the expenses directly related to patient care. The average medical expense ratio was 92% for all firms, an increase of 5.9 percentage points from the same period last year. It is important to note that these 6 companies operate different models and the ratio varies. One Medical, which is only just entering into the risk space, has the lowest medical expense ratio of only 84%. The administrative expense ratio for these firms is calculated by dividing the total administrative expenses, including depreciation and amortization, by the total revenues. The average administrative expense ratio was 26%, a 4 percentage point increase from the same period last year. This includes expensed development costs. Non-operating earnings, on the other hand, increased by $85 million to a gain of $36 million. Our calculation includes the sum of investment earnings, income earned in non-health lines of business, and less interest expense. Net earnings for the fourth quarter were lower compared to the fourth quarter of 2020. Net earnings increased in total by $115 million to a loss of $308 million. Oak Street Health had the largest net loss of $140 million. So in a nutshell, these companies are incurring the costs of rapid growth as they develop their respective franchises. These losses are investments that they may not capitalize. Let me end this presentation with a plug for a free publication that we are introducing next week. It is called Snapshot, and it's a weekly summary of key valuation and operational metrics for the value-based care segment of the healthcare industry. It will be very brief, but we hope that the key performance indicators that we are publishing will prove helpful to your thinking about this exciting segment and its prospects. Let us know if you have an interest in this free publication. You can either reach out to MCOL or you can reach out to us at asherlock@sherlockco.com. This is Doug Sherlock of Sherlock Company. Thank you.
Thank you, Doug. You've been listening to Doug Sherlock share his quarterly insights into the financial performance of value-based care organizations. Thank you.